Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my trusty co-host, Cris. Hey, Cris.
Hey, Mark.
Where's our other co-host?
I think she's what is it, pickleball circuit or something along those
Some such
lines,
stuff. Oh, she's playing pickleball. I didn't know that. She's good at that,
apparently.
apparently. Good. Do you play? No, you play bocce ball or bocce
Oh,
ball, whatever that is. That Italian, that weird Italian sport.
yes, there you go. There
Yeah.
you go.
Yeah, well, the last podcast, the debate was whether folks like the chit chat, which is what we're doing now, the chit chat. And I'll have to tell the listeners, we're not going to tell you, we're not going to spill the beans this because we're still collecting responses. But boy, the responses, right? The response rate's better than the BLS, I think, for the employment report. We got a lot of
Unfortunately, yes.
response. And the good news is we got a definitive answer on whether people like the chit chat or not. So, but I'm not going to tell you what that is. And the reason why we're not going to chit chat is because we have a great guest and we want to get right to it. It's Austan Goolsbee. Hey, Austan.
Yeah, Mark, how you doing? Cris, good to see you.
Yeah, doing okay. And thank you for coming on. Austan, of course, is the president and CEO of the Federal Reserve Bank of Chicago. And you've been at this now for a little over a couple of years, right? You've been the president.
Coming. It's my third year. I'm in the middle of it. Now,
Right.
Mark, you didn't tell them. The folks on Squawk Box always said that Mark and I had this Clark Kent Superman thing going, that they never saw us in the same room together. Now that was, I used to have as much hair as Mark had. And I said, that's absurd. That's offensive. How could you even say that? And then one day, it was a Sunday, and my wife came in and was watching Meet the Press, and it cut to this panel. And she said, honey, I had no idea you went on Meet the Press this week. And I said, that's Mark Zandi. So that was a tough one to swallow.
Austin, so I'm ashamed to say I forgot all those CNBC days, those employment reports. We did that for a long time together, right?
Yeah, exactly.
Remember we had to put on a card what we thought the number
was.
was?
And then they would count it down, and they would try to embarrass us. But we did pretty well, I think.
Well, I don't remember it at all, so that's good. I'll take it. I'll take that. I was reading through your Wikipedia page, and I didn't realize you've been on, and it sounds a lot because your accomplishments are many and just an amazing career. But I focused on this one thing, and that is you were on Jon Stewart for like 6, 7, 8 times. That's
a bunch of times. That was the most fun thing they let me do in the government.
Oh, is that right?
Yeah.
Right. I'm surprised they let you do it. That's so cool. And then Colbert too. I saw you were on Colbert. That's
cool.
A
couple of times on Colbert. That was all of those were pretty fun. They're both interesting characters.
Yeah, maybe I'd love to hear that backstory someday. But yeah, that was during the financial crisis, and you were a member, and then ultimately the chair of the Council of Economic Advisors under President Obama in, I think, 2009, 10, and 11, right? Those 3 years.
Yeah.
That must have been
first like 3 years.
That must have been amazing.
It was amazing and awful at the same time.
Yeah.
It was as I say, it was a bunch of like, we're eating Tic Tacs for dinner and getting a few hours of sleep under the desk kind of thing. But it was looking back, as far as financial crises go, it actually ends up being the least costly as a share of GDP financial crisis of all financial crises ever, I think.
Is that right?
And so it's sometimes it's funny to look back. The economists would say, and the financial analysts would say, hey, if you ever get in a crisis, this is a way you should do it. Because look, it ended up, the normal cost of a financial crisis to the taxpayer is 5 to 10% of GDP. So that beats $2 trillion kind of thing. And they ended up, by taking warrants and doing various things, it ended up costing close to zero to the taxpayer. They paid back the money that they had borrowed. But the political lesson is the 100% the opposite. You know, if you analyze how do you deal with a financial crisis, put money into the banks, take warrants, try to rebuild the capital. But every government of the world that did that, kind of the government fell and they were run out of town on a rail. So hopefully we never face those conditions again, but it was certainly harrowing. I mean, you remember that.
Oh yeah. I mean, I've been a professional economist for 35 years, and that stands out by orders of magnitude.
Yeah.
Pandemic, it was a big deal. What we're going through now feels,
Yeah.
in terms of the uncertainty, and we can come back to that. But that, particularly when you guys took office in January of 2009, didn't we lose like 1 million jobs or something on that in that month?
Yeah, no, in one month.
Yeah, 1 month, literally 1 month.
It was 850,000 or something in a single month, and I was like, "Whoa!"
Yeah.
You were never, as I said along the way there. 1 month it was expected to be like minus 400,000, and it was like minus 275,000.
Yeah.
And I was torn because I was like, I'm never in my life going to say that a minus 275,000 jobs in a month is a good news. But in a way, it was good news. It was at least better than progress.
Right. Hey, I've had folks on the podcast that have been through that period. And the one question I asked them, and I'll ask you, because there's a gazillion policy responses, and many things the Fed did, regulators did, of course, you did, the Obama administration did. Of all the policy responses, could you single out one kind of at the top of the list of things that you felt really was helpful or turned things around, or is that impossible to do?
There were so many things that it's like if you single out any one, it's going to seem like but that was just a biscuit, in a whole Thanksgiving meal. That said, I've characterized what I consider the Washington way to be, you got an argument about worldviews, and in the end, they just decide, okay, well, let's do 1/3 of each, and everybody gets part of what they want. And that, in the argument about the stimulus in 2009, there were at least 3 different worldviews. One worldview was, this is going to be a V-shaped recovery because it's a deep downturn. There's going to be a steep comeback. So don't do anything lasting and permanent or long-lived, because by the time it comes on, it's just going to be inflationary. So that was let's make it timely and targeted and temporary, and let's move 2010 into 2009 kind of activities, first home buyer tax credits, cash for clunkers, stuff like that. And then there was a second group that was saying, no, look, it's a financial crisis. This thing might go for a long way. Let's invest in infrastructure. Let's invest in energy and upgrade the grid. And there was a third group that was kind of saying, we got to get 50 votes, so let's just make it all tax cuts, and some Republicans will want to go along. And they kind of went back and forth, which is right. And in the end, they said, let's do 1/3 of each. And so looking back, it wasn't a V-shaped recovery. So the inverse of your question, I think if you knew what you knew, I understand why we did it the way we did at the time. It's because we didn't have the information. If you understood it wasn't going to be a V-shaped recovery, you would have done a lot less of the temporary stuff, and you would have done more in the longer run investments. And I think if you go look at those, if you had to single individual things out, there are a series of long-lived investments that were really good ideas, including one that fell by the wayside, the Build America bonds. I thought was an excellent way to finance infrastructure, and Race to the Top, where they outlined kind of a contest, a challenge grant to improve education. You got a lot more bang for the buck than if you had just given the grant out to one. A bunch of states applied to try to get the money, and even the ones who didn't get it said, well, you know what, let's do it anyway, because we've done all the strategic thinking.
Yeah, a lot of things. The one thing that stood out for me was when the FDIC decided to guarantee bank debt. That on that day, that's when funding, kind of
I see. So from the financial perspective, I mean,
financial perspective.
there were a couple of moments where in a way we got fortunate that we might not have understood it in the moment. When we announced the stress test, you'll recall there was that speech that Geithner gave, and then the market went down, and people said it was because he looked too young or whatever.
Yeah.
I don't think it was. My take at the time was we announced there's going to be a stress test, but fundamentally, the world wants to know what's going to happen if somebody fails, because they think there are a bunch of institutions that are going to fail the stress test.
Right.
And who's going to take the first loss?
Right.
Once they start guaranteeing the debt, and once they make clear, okay, here's how it's going to work. The government's going to take the first loss, but they're going to take warrants. We're going to do the stress test, and it's not going to be the end of the world. That opens the door for private capital to start coming back in. But where we got fortunate was when they did the stress test and they opened up the books, the actual conditions of the banks were not as bad as they feared.
Mm-hmm.
If they had been worse, and there was an argument at that time about Europe, that Europe didn't want to do the full open all the books, full kimono strategy,
right?
Because maybe they don't look as good. There was a period in the Depression where the government kind of announced, we're about to wipe you out. And they paid out huge dividends and huge executive compensation, knowing that the alternative was the government is just going to come in and take everything. And so we did get a little fortunate that the actual conditions were better than what was feared. If they had been worse, I wonder if we would have then gotten into a big fight about, wait a minute, you let them pay out dividends and you let them, there weren't restrictions on compensation.
Well, there was just one other thing in your bio that I wanted to just call out, and that's your relationship with Chip Case. I didn't
Indeed.
That I did not know.
Okay, you didn't know that.
No.
So Chip Case's wife, Susie, was a counselor at my high school. And I came in and I was really into science and math, but I was really into debate and current events. And I had kind of, in high school, thought maybe economics is a combination of math and science and current events. And even though I was uninformed, that's not totally wrong. And so she asked me, what do you want to be when you grow up? And I said, I think I would like to be an economics professor. And then she started laughing. And I said, why is that funny? And she said, well, my husband's an economics professor. And so you could talk to him and he would help you. And he kind of took me under his wing. He'd help me. He started bringing me to NBER academic seminars. At that time, he was working on housing, and housing was a very hot moment.
Right.
So even though they don't remember it, Larry Summers doesn't remember. I met all of these guys at seminars when I was in high school, because Chip would bring me down. Wow. And I got to know Bob Schiller decently well. And he was just a wonderful mentor to me, and really opened a lot and helped me get a first job in high school at the Boston Fed. I was a research assistant for this guy, Steve McNeese, typing in back then. Somebody had to type in all the forecast data. So I would get everybody's forecast and I would type them all in. And he was just couldn't have been kinder to me.
Well, he played a really instrumental role in my career as well.
Really? How was that?
Well, when I started a company back in 1990. It was called Regional Financial Associates, and a big part of it was providing information to banks who were now, because of interstate banking. So they were trying to understand the housing and mortgage markets in places in the country where they weren't operating. And that's when Chip and Schiller had come out with their HPI, their house price index.
Yeah, exactly. So
I funded that. I not fully funded. I partially funded the development of that index.
Really?
Yeah, at the beginning, and we used it in I think we were the first study that used it, because we took it, we modeled it, we produced forecasts for it, that kind of thing. And then because of that experience, and he's the greatest guy on the planet. He was on the board of directors of MGIC, the mortgage insurer, the private
Oh,
mortgage
right,
insurer.
right.
And so when he retired from the board, he brought me in and said, you got to bring Mark Zandi in on the board. So I've been on the board since 2011 because of Chip Case,
Hey, look at that.
Yeah,
He's a good talent scout. He
yeah.
picked you out.
Great guy. He was
Yeah.
such a great guy. And I got to know through Chip, I got to know Schiller a little bit better as well,
Yeah.
and Schiller is the most interesting character. But I digress. We got a lot to talk about.
Sure.
Let's move on. Let's talk about the economy. And, 3-4 times a day, I get a very simple question. The question is, how's the economy doing? So, Austan, how's the economy doing?
Yeah, but don't you always, the State of the Union is strong. That's always,
right.
it's weird. The state of the economy is weird.
Weird.
Unprecedented. There's a lot of uncertainty, but there is a lot of strength too. If you just look at the hard numbers by Fed dual mandate grounds, that is, law tells us stabilize prices, maximize employment. That's what we're thinking about all day, every day. If you take 2023, that's I come in January of 23 to the Chicago Fed. Inflation still kind of raging out of control, got way, way up above target. And almost everyone is saying you can't get inflation down without a deep recession. You've got Larry Summers saying the unemployment rate is going to have to go above 6% for 5 straight years if you want to get inflation down. If they had existed at that time in as advanced a form as they are now, like I say, if you had typed into ChatGPT, how can we get inflation down? It would have said, jack the interest rate up and have a deep recession. That's the only way to do it. 23, among the biggest drops in inflation ever, and the unemployment rate never goes above 4%. 24, inflation continuing to moderate with unemployment staying in kind of this full employment sort of level. And there is a sense in which, as we come into 2025, things are looking pretty good on the hard grounds, in the hard data, which is different from the vibes, which we may want to talk about. Then we start throwing, in my view, a lot of dirt in the air. We're going to announce tariffs. We're going to announce a bunch of things that I start hearing from the business folks out here in the Midwest, in the 7th District. They're super nervous that this is going to take us back to a period where the supply chain is disrupted and costs are going back out of control. But we haven't really seen it yet in the data. And so then I started getting more comfortable with the idea of, like, okay, if this is what the impact of tariffs is going to be, maybe the industry folks whose hair was on fire, they're now, when I'm talking to them, they're a little less hair on fire. And they're saying, we got some exemptions. They put some stuff off. Maybe it's not going to be as bad as we thought. To which I was going to go back to, great, rates can start. I thought before, if U is close to U star and pi is close to pi star, then R should be going down to R star. And that's where we were. Threw dirt in the air, kind of complicated it. But maybe we can go back to that. But we can't get a break. I mean, now we're going to announce a new round of tariffs, and we're going to raise it on copper and intermediate goods. And we've just got to get a handle on this part of the uncertainty before we can truly answer the question, how is the economy? Seems like in the hard data, it's going okay, better than okay. It's going well. But if we every 6 weeks have to revisit whether we're about to have some big supply shock, that's messy at the least. So
just to restate it back, just to make sure everyone understands, what you're saying is, look, the Fed, in terms of its mandate, has pretty much achieved what it needed to do. It got we're back to full employment. The unemployment rate's around 4, a little over 4%. That's full employment. Inflation feels pretty good. It's not quite back to the 2% inflation target, but within spitting distance.
Yeah, like on the path.
On the path.
Coming down.
Direction of travel, clearly. And, if that's the situation, then you'd say the federal funds rate, the rate I control, should be back to something that's consistent. You said R star is that rate.
Yeah, like a settling point where you think things are going to settle down. Exactly.
Where it's policies neither supporting or restraining economic growth. And we're above that now because of the funds rate.
That's what I
4%.
think.
Yeah.
Yep. That's what I think.
But then what comes along economic policy, and you focused on the tariffs, but there's other stuff. And you're saying your metaphor is dust in the air or dirt in the air. I threw all this stuff out there, and now I don't really know. I have to wait till the dust settles before I can make a decision around, interest rates and policy going forward.
That's kind of how I've been feeling. And there is I gave a speech in January at the big Auto Insight Symposium. They had been talking about tariffs, and I outlined I guess it's kind of a hypothetical. I said, look, if they put in big tariffs, there is a theoretical argument that a one-time tariff that just raises costs, even if the tariff is permanent, that's a transitory inflation shock. So there is a theoretical argument that you should just, in some ways, just ignore the tariff, the part of inflation that comes from a tariff. And I said, the problem is there are going to be two problems with that. The first is that's exactly the same logic that we used. I shouldn't say we, I wasn't there. So don't blame me. But that was the exact same logic that the Fed used coming out of COVID to say, hey, any inflation we get is going to be transitory because the supply shock part is going to be transitory. They're going to fix the supply chain. The demand stimulus is going to be transitory. It's going to be a one-time level increase. And it proved to last far longer than the theory said, because the supply chain is more complicated and more spillover-ish than we understood. So that there's a threat of that with tariffs. And then the second is in an environment in which it's not a theoretical one-time platonic ideal of a tariff, but it's instead, we're going to revisit in 30 days, we're going to up it again, we're going to do another. The threat is that it can jump out of its lane. So my starting point was always the US, as you know, is overwhelmingly domestically driven. Imported goods, which are what the tariffs basically applied to, that's only 11% of GDP. So there is a sense in which even a pretty big tariff, is it going to be so big? It could be noticeable without being material at the macro level. It could kind of change relative prices without generating aggregate inflation. How does it get out of its lane, its 11% lane? If it leads to retaliation, then it's automatically doubled its lane because now exporters are facing it. B, if it's applying to intermediate goods and components and parts and supplies, now it just got out of its lane because it raised domestic production costs, and that's going to flow into inflation. But the third and the biggest potential is if it leads people to freak out. If the chaos associated with unbridled trade wars leads business or leads the consumer to pull back, you can get a recession easily. And I have cited the example back in 2001. Everybody remembers that as the internet bubble popping. But the thing is, the internet wasn't big enough to cause a recession. That shouldn't have been mechanically a driver of recession. It was because of the freakout channel. So those three things are the dirt in the air to me. And we just need to know, let's call it the argument is, one side says if the inflation's coming from tariffs, we should look through it because that'll probably be transitory. But how do you know? Are we going to be in an environment where inflation is actually rising, whatever, 3%, 4%, 5% annualized rate? And the Fed is trying to decide which parts of that should we ignore and which parts not to ignore. That's not an easy question.
Yeah, I like the freak out channel. I hadn't thought of it that way. The freak out channel. I guess the one way the inflation from a tariff, and it is initially a one-time pop to prices, can metastasize more broadly is through inflation expectations.
That's a good point.
Right.
That's a good point.
And here it feels like it's consistent with the dust in the dirt in the air kind of metaphor, because it's hard to read inflation expectations. There's so many different measures. There's expectations based on consumer surveys, University of Michigan, New York Fed, Conference Board. There's bond market inflation expectations. How do you, and I assume that that's a key variable here in terms of your thinking about whether the price increases from the tariffs are going to become more sustained, more persistent. And if that's the case, what do you look at? What do you think about when you're thinking about inflation expectations?
Look, that's a key concept. I agree. I have, before we ever got into tariffs, before April 2nd, I have always put more weight on market-based inflation expectations like TIPS measures or inflation swaps than I have of consumer surveys. And that's been even more true lately, as it has felt like a lot of the sentiment surveys, their relationship to the hard data has broken down a little bit, or they become more indicative of the respondents' political affiliations than they have about their true opinions about the economy in ways I don't fully understand. And I'm a big proponent. I love the University of Michigan survey is done in the district, and their chief economist is on our academic advisory council at the Chicago Fed. So we've thought a lot about and have a lot of respect for what they do. It is the case that as the response rates to all surveys have gone down, and as they've shifted to the internet, there is at least some component that, for whatever reason, people on the internet are a lot grumpier than people who are answering by mail. So there is some, you got to try to separate out what is happening. If you see a drop in sentiment or you see a jump in consumer expectations of what do they say inflation is going to be, how nervous should you be about that? I would characterize, this is the long way to say, I would characterize the market-based measures of long-run inflation expectations have mostly not moved. And that I take some comfort from. The short-run measures and the consumer measures went up pretty significantly when there was lots of public discussion of tariffs and how much they were going to cost. So in a way, I wasn't surprised that the more you read in the media about prices going up, and then they ask you, what do you think is going to happen to prices? People started saying, oh, I bet they're going to go way up. And my only hesitation is inflation expectations is a really important measure, but if you started to see expectations going up, now we're back into the realm of psychology. That's not exactly, inflation expectations is not in the mandate for the Fed. The mandate is about actual inflation and actual employment. And
it's in your reaction function, though.
It's in our reaction function. That's what I was going to say. It is in our reaction function. It is a very good indicator, we think, of where inflation is going to be going and how hard it will be for monetary policy to get rid of inflation if it were to appear. But I am so far find at least comfort that it does not seem like the world thinks that the inflation shock is going to be a long run hit to I said the tariff. I think I mixed up the words. that the tariff is going to be a long run hit to inflation.
Yep.
But of course, within inflation expectations is this reflection problem. It might be that the market believes there won't be inflation because they believe that the Fed will do whatever it takes if you see inflation going up, that the Fed will do the equivalent of raising the interest rate.
Right. Got it. So just to paraphrase, inflation expectations as measured by market-based measures, like bond market measures, a little higher weight just because of the survey issues that are.
That's what I think.
Yeah. And right now, certainly long-run inflation expectations embedded in bond market are pretty sanguine. They're pretty stable.
Yeah.
So that would kind of suggest that it's not, it's an empirical question. We'll have to see how it goes. But right now, it feels like the tariff increases will be more one-off than they would be persistent because of that dynamic.
That's what I'm hoping.
Yeah. Right.
As long as you don't go look at the other expectations. If they are expecting big increases in interest rates, and that's the way the market is translating why they don't think inflation is going to go up, then you would want to think that through that scenario. Pretty.
And of course, that's not what's the case, because if you look at interest rate expectations, it's for cuts. Coupled.
It is for cuts, though. You're seeing. Yeah, I mean, we're going to get into this discussion about loan rates. I don't think that much of the increase in loan rates can be explained by expected increases in inflation, long run inflation. So that's at least good. That keeps us grounded in reality. And like I say, before there ever was April 2nd, my headspace that I had expressed many times was this: hey, inflation's coming down. I feel like this is the path to 2%, and we're at stable full employment. So I have no problem in an environment like that thinking about where do we think the ultimate settling point is of rates, and let's start getting to it. It's just this: if we're going to go into an environment where prices are going to start rising again, and when I'm out all the time talking to people in Michigan, I just got back from Iowa, I'm over in Indiana. If they're telling me our costs are out of control, our supply chain is disrupted, I'm going to be nervous. I got to wait until that noise kind of dies down, that anxiety dies down, before I'm going to be comfortable that we are back on the old golden path, as I called it, to a stable soft landing.
Got it. I want to, Cris, I'm going to bring you into the conversation in just a minute, but we'll explore one other thing about the economy. You kind of gave the sense that the economy's, it's okay, it's doing fine, came into the year very well. But let me push back on that a little bit. I mean, growth rates feel like they're throttling back. I mean, if I just look at real GDP, that grew, almost 3% last year. That was a pretty good year. And if you look at the first half of this year, and of course we haven't gotten Q2 data, but if you take Atlanta GDP now, it's 2.6. If Q1 was negative, you kind of average. Feels like it's half the growth rate in the first half of the year is half of what we got last year, and it's below the economy's potential. And you're also seeing consumer spending basically going flatline here since the beginning of the year. Job growth is slowing. Unemployment hasn't risen, but that might go to supply side issues. The labor supply in force has slowed. So when I look at that, I see an economy that, it's not recession, but
dangerous warning signs. It sounds like you say. I'm going to dispute that. I'm not disputing that.
Okay.
The thing is, here's another case where the most obvious dirt in the air from tariffs discussion is on prices and things like that. But a second form of dirt in the air is there was a bunch of front running. And you see, if you go talk to business or if you look in the data, people buying cars, buying iPhones before the tariffs come in, stockpiling of inventories. And that's some component of the drop in GDP that we saw in the first quarter. You see a big surge of these imports that kind of have yet to show up in the normal data. If you just get down in the weeds, if you buy a car that's made outside the US, the import part is a negative and the consumption part is a positive, and it's supposed to have zero impact on GDP because it wasn't made domestically. We kind of saw a bunch of negative, and we have yet to see the positive. So there may be just like a temporary accounting-based surge in the next quarter. And so that, to me, is just the same dirt in the air. We just got to step back and kind of average through. I like how you said if the GDP now were right, and then you average that with the first quarter, wouldn't that be a slowing? Yeah, it probably would. If we came back with even the rebound GDP was below potential, then that would be more of a concern of growth. It does look like it's slowing, but I'm not yet ready to conclude that growth is slowing. You haven't really seen layoffs go up by a lot. The unemployment rate is still fairly stable. When I'm out talking to business, they're generally saying we're a steady as she goes economy, except that the uncertainty has us in we had the big Fed Listens event here at Chicago Fed, and a construction firm from Indiana said, we're calling this our pencils down moment. That it's like, we can't go on to the next section of the test until we get some clarity of what are we doing?
Right.
And I think that's the same uncertainty as dirt in the air point.
Right. Hey, Cris, let me bring you in the conversation.
Yeah.
Listening to this, what would you like to? What question would you like to pose to Austin?
I guess along the lines of
be gentle. Be gentle. You can tell.
Yeah, come on, Cris.
You can tell he's fragile, so you can tell that. So go ahead.
I'm curious to hear your thoughts about tariff-induced lags in the tariff-induced price increases, right?
Yeah,
so
yeah.
It could be, things look great now, things look okay, they're moving in the right direction, but there's certainly a narrative out there that businesses are eating a lot of tariff increases, not passing them on to consumers. The high-end consumer is still relatively well in spending, so maybe we're seeing some growth there. But is there another shoe to drop, and when do you expect? Assuming, obviously policies.
That's what I'm going to ask you, Cris. Is there another? Look, this is the key point. This is absolutely the key point on the tariff question. And Mark, I like that you said there are a lot of other questions going on too. But on the tariff question, it has been surprising the modesty of the impact of tariffs on prices so far. We've had 3 excellent inflation reports, and 1.5 months of those 3 months, I would say, tariffs were kind of in place. If we got a few more months like that if we found that the kind of the residual seasonality issues that in the Qs 2, 3, and 4 of the last several years, we've seen inflation moderate much more than was expected. If the impact of the tariffs is kind of smaller than that, so that we basically don't even see a material aggregate impact, that would be pretty notable. And I would that would persuade me we're on the golden path. We never left it. It's fine. The dust is gone. Let's keep moving. But we just don't know. In a way, the previous argument was, we know prices are going to go up. One side is saying you should ignore the prices going up because it's transitory. And the other saying, I don't know if we can ignore the prices going up. We might have to wait until the prices come back down. I kind of think on the bingo card of nobody was prices don't go up. So we're just waiting for the shoe. This is sort of the basketball game was last night and you taped it and you want to watch it. And you're like, don't tell me. I don't want to know who won. Like, do we already know what's going to happen? And it's only because the data are coming out with a lag that we haven't seen it yet. I don't know. That's the core question.
So this I don't know if you want to go here or not, and I'm sure you'll tell me if not. But fiscal policy. So there's a lot of economic policy. We talked about tariffs. There's the immigration policy. There's DOGE cuts. There's also the recently passed BBB, Big Beautiful Bill, HR1, reconciliation package. And, my take on that is it from a macroeconomic perspective, there's a lot going on there, and there's a lot of impacts on different groups and different companies and businesses. But from a macro in aggregate perspective, it's not that big a deal. It doesn't juice growth. It doesn't weigh
in the
on
short run.
In the short run.
I do think there is a sense in which, in economic stabilization terms, it feels right. Everything's delta from last year.
Right.
And how much more or less does the deficit get in 26 than it will be in 25?
Yeah.
Might be modest.
Might.
Over a 10-year period, seems like it's 3.5 trillion or something of fiscal stimulus, if you want to think of it that way. But the longer the period it goes, the less direct and immediate impact it has in the economic stabilization front. And I kind of got out of the fiscal policy business when I moved over to the Fed. So as I always say, our motto is there's no bad weather, there's only bad clothing. That comes from our Chicago way. And for the Fed, fiscal policy is just a weather. Those are the conditions, and we got to prepare the jacket. If you're afraid of overheating, hey, $3.5 trillion of fiscal stimulus, that might make you nervous. If you're of the view, no, wait a minute, the economy seems like, if anything, it's slowing, not overheating, and that fiscal stimulus part of that thing is spread out over 10 years, and it's not going to be a ton at the beginning anyway, then it's more likely irrelevant. Yeah,
I mean, I was thinking of it more from a kind of a current policy basis. Meaning,
no, exactly. That's what I call the delta from last year.
The delta from last year.
Yeah.
But even in the long run, this neither adds nor subtracts significantly to the deficit. But what we're left with are big deficits. So the deficit is 6% of GDP. The primary deficit, excluding interest payments, is 3%. We're at full employment. In full employment, you really should be at zero or even in surplus. This is pretty bad stuff. I'm not saying this bill should be worse.
This is pulling us into there was a time in my life when I was heavy into the fiscal policy business.
Okay, fair enough.
And I don't, that one, we just got to take it as given the conditions.
And I'm going to respond.
With the one exception being, to the extent that now there are people arguing, it's like they're advocating the fiscal dominance position, that the Fed should cut the rates to make it easier, / less costly to run more debt. Let's be a little careful with fiscal dominance. As you know, there's not a great history around the world of fiscal dominance monetizing the debt as being real consistent with the dual mandate.
Yeah, meaning ultimately that lands us in a bad place. Generally, inflation, ultimately weaker growth.
That's what it is. In the pure theory of the game of chicken between a central bank and a fiscal authority, I do think it's pretty important for the Fed's reputation and Fed credibility that we're not engaged we're not pre-committing to that. We're gonna make it as easy as possible. We should be looking at our mandate and committing to the world. What we do is we look at prices and we look at employment, and that's what the law tells us we have to do.
Got it. We got about 10 minutes left, Austan, and I kind of want to think a little longer run, if it's okay.
Yeah.
And, a lot of your work before you joined the Fed Reserve was around. You're an academic. One thing I didn't mention, obviously, you're a professor at the University of Chicago's Booth School, and you've done a lot of great research. In fact, your paper on construction productivity, in my world, created a pretty big stir a couple of years ago.
Construction productivity is real bad. That's a whole.
That's really bad. It's really
literally negative productivity for decades. I still don't understand it, but
Well, it generated a lot of. You probably missed a lot of what was going on underneath in the construction world, in the housing world, but that really generated a lot of buzz. But I want to talk about artificial intelligence, if you're okay with that.
Sure.
And get your take on, this kind of, there's two, I'm simplifying, but two views. One is a kind of a sanguine, very positive view. This is going to generate a lot of productivity growth. And of course, productivity growth is key to everything. Living
make us rich.
Yeah, make us rich.
Yeah.
The other is a dystopic view that the productivity gains effectively are going to come on so fast, it's going to wipe out all these jobs, and we're going to be left with, high unemployment. People just aren't going to be working. Do you have a perspective on that? How do you think about that? I get this question all the time.
I'm closer to the economist view. That's kind of historically, the economist view is we've had hundreds of years of technological change and technological replacement of jobs. And over the medium, long, and oftentimes even in the short run, it'll be fine. We want productivity. It makes us rich. That's kind of the economist view. And the technologist view has been, you have no idea how great this is. This is the greatest thing that has ever been. It's going to wipe out everyone. And we've been through a series of these over the last 10 or 15 years. You'll remember within 10 years, there won't be a single professional driver in the country. All trucks will be self-driven, all taxis, all driving of every kind. And that's one of the most common occupations. So get used to disappointment. I think the speed, you identified the key decider in that is how fast does it happen.
Mm-hmm.
But it's worth remembering previous general purpose technologies. I don't know that AI becomes one, but if it does, if it becomes like electricity, computers, telephones, et cetera, it's worth going back and looking at the adoption of previous general purpose technologies. It's not instant. And it follows a pattern where the productivity growth is extremely high in the generating sector itself, and then with a lag to the heaviest users. And then only with even more lag does it spread to the rest of the economy. And Paul David had that really important piece on the adoption of electricity. And I think the dynamo and electrification of manufacturing plants was available by the late 1800s. But even as late as 1925, literally 50% of manufacturing was not electrified. And that just kind of tells you there's a long tail of adoption, which might mean that the impact of this thing is not as rapid as the dystopic vision relies on. And while a large fraction of people have sampled LLMs, the actual penetration rate of regular usage we're still at very, very early stages on this. So we're just going to have to see how it goes.
Yeah. Yeah. That makes sense. I think that's most macroeconomists kind of think in that way, that, it's when you see a technology, even if it hasn't come to fruition, like a driverless car, a driverless truck,
yes,
we know it's going to happen. It's going to happen. We all think it's going to happen immediately.
Right.
There's just so many frictions and so many things that get in the way, slow things down. And that's what you're saying.
That's what I think. That's where I think we are.
So we're going to get those productivity gains. It's going to be, but if history's any guide here.
And I gave this speech out at Hoover saying, here's some evidence. I presented some evidence that maybe AI is a little bit behind this surge of productivity that we've seen, even though that seems improbable because it's not big enough yet. But it was added the cautionary tale. If you get big productivity growth shocks that are forward-looking, you do got to be careful not to get way out over your skis counting on that. So if valuations go way up and businesses start massively investing, counting on the productivity gains that are about to be realized, and the entrepreneurs start spending money out of the wealth that they're getting from these valuations, you can overheat the economy in the short run, and you can be due for a rude awakening even if what happened in 2001 is everybody counting on the internet growing at 20% per year. Then when it came in, it was like, well, maybe it's only going to grow 5% per year. We had all of this overhang of investment, and that kind of sent us into the freakout channel. So we want to be a little careful, not getting over exuberant about these productivity gains. Let's kind of make sure that they're there before we spend the money.
Well, although this does feel a bit different, right? I mean,
yes,
yeah, right. Can you go?
Yes,
I mean, because
it's a cousin. Back, it's definitely not a twin.
It's not a twin, right?
Yeah.
Okay. All right, we're running out of time, Cris. I'm going to give you the last question, so make it a good one.
Okay, on that last one, I'll cut a little closer to home. What do you think about using AI to run monetary policy?
Okay. Now, there's a Fed rule. You can't put any secret Fed data into one of these things, and we're not supposed to use the output from an LLM for
rules can be changed
unless it's adjusted. My thing is, and we talked about this a little, the AI is as good as the training sample. And what we've experienced the last 5 years was totally unprecedented. I mean, we had a deep recession, which was not driven in any way by cyclical industries. It was driven by services. And we've had a big drop in inflation without an increase in the unemployment rate. And things like that, you got to know something about the economics to predict. So as it was happening in 23, I started saying, we might be able to pull off the golden path because the economics of supply shocks are different than demand-driven business cycles. I'm a little nervous that the kind of the standard of what everybody says on the internet, which is in a way what goes into the training sample, that might not be that great. I could be proven wrong, but and I come to it wanting it to work, but at least if it's the Google AI overview, it's frequently wrong. And so I still think job security for central bankers is at least more secure than the biggest advocates of AI believe. And
economists, Austan, you say
economists, what's their job security? I don't know. You better improve your advice there.
I know.
Mark. That's where your job security is going to come from.
There was a great study that I can't remember who wrote it. It came out about a year ago where they took all the folks that contributed to the Philly Fed survey, that long-running survey, and I'm one of them. And they did build a LLM that beat. It was trained on their forecasts and other information, but beat the economists. Yeah.
Look, it could be that this thing is a revolution in forecasting. That'd be okay, but the judgment. I have a friend who's a prominent doctor, and one thing that a lot of doctors, the ones that have a high patient care, they got to fill out their notes, and it's very onerous. And there are AI tools that there's a section in the notes they describe, which is kind of like presentation. And then there's a section of, and what do you make of it? And this friend of mine described that the presentation and what might it be, it does pretty well. Like, it is accurate. It'll listen to the patient, and it'll give the summary, and she'll say, oh, this was a good summary of what I said and what the patient said, et cetera. And then when it's like, and what should you do? It's like 10% accurate. And that's the money part of the thing.
The money part.
It was like, I don't want to be prescribed, eat 3 rocks and, have a Dr. Pepper.
I know you got to go, but one final thing. In your bio, I think this was in a frontline interview I was looking at that was on your Wikipedia page. You said, I want to be 80% Paul Volker, 20% Muhammad Ali.
Yeah, I said that was my goal in life.
Yeah,
that was my goal in life.
Can you explain? What
Well,
was it?
look, but Paul Volker was a real mentor of mine, and I worked with him through the financial crisis. So the
80%.
alternative would be that you would aspire to be 100% Paul Volker.
Yeah.
But I never took myself that seriously, and 20%, like I want to have fun and
okay, there you go.
Little
makes sense.
Little taunting, never hurt. Taunting the other reserve banks never hurt.
Yeah, I agree with that. So, hey, Austan, thanks so much.
Hey guys, what a fun conversation, and we
never played the stats game. No stats game.
Oh,
so
you want to do stats game? Let's do stats game. We'll take 1 minute. My stat.
Yeah, what's your stat?
You're never going to guess it.
Oh,
but I'm going to give you a hint.
Okay.
As of June 24th, 223%. That's the stat, or 2.23.
223. You said you were going to give us a hint.
Is it a
commodity? The hint was it was June 24th. So you'd have to know what came out on June 24th.
What the heck happened on June 24th? No,
you'll never get it. That's the day that the FHFA house price index came out. And as of that day, which goes up to April, so the data goes up to April. Right. And I think it's a repeat sales price index.
Yeah, it is. It is.
It showed house price inflation of 3% for the year.
Okay.
And we've had a whole bunch of discussion. You hear a lot of young people saying, my dad, had only one job in our family, and he was able to buy a big house, and I can't afford a condo, and housing is super expensive. The 223% is the relative price of housing compared to durable goods. Okay. So it's been extreme lately.
Right.
But for over the last, that was from December 2011. Okay. So for 14 years, and even going back before, we had inflation less than 2%.
Yeah.
House price inflation was 3.5% to 4% a year. And goods inflation was like minus 0.5% per year. That's been true for 15 or 20 years in a row.
Right.
And so here we got in 12 years, the relative price of housing is up 223% relative to TVs and Pelotons and stuff you buy at Costco. And part of that maybe is from regulation, building regulations. Part of that is from, I don't know what, but that idea that I think a lot of what people are striking out at when they say there's an affordability crisis is they're actually noting a massive shift in relative prices, which is different from what the central bank is doing. The central bank is looking at the overall price level, but it doesn't have we have a 2% inflation target. We don't have an ability to target house prices and get house prices back down to the relative price they were in, when your father was buying a house in whatever that was, 1965. And so if we were going to talk about that, I know you both know a ton about housing. And I was going to try to get you to explain to me, why is the relative price of housing drifting up so dramatically over such a long period of time?
Well, we'll have to get you back on. And, you're right. There's like zero probability I would have ever gotten that statistic.
Exactly.
No chance.
No way.
June 24th, that's your hint? Are you kidding me?
No, that was the only hint. So how good are you? Look, the ChatGPT would have got it.
I'm not so sure. Now our co-host Marissa might have gotten it, but anyway. Hey, thanks so much, Austan.
Yeah, you guys, this
really
is a real treat.
Thank you so much.
Look forward to seeing you again soon.
Take care now.
Thank you.
And dear listener, with that, we're going to call it a podcast. Take care now.